Sam LaPrat Show continues on City News.
101.1 FM and 1310 AM.
Welcome back to the Sam LaPrat Show. Derick Fage here from Rogers TV filling in for Sam. Well, you've probably just heard in our news just a few moments ago, the Bank of Canada raised its overnight rate by 25 basis points to 4.75%. Recent economic data has suggested the Canadian economy is running hotter than forecasters had expected, raising concerns about the inflation outlook. And I'm sure when you hear the economy is running hot, you're probably thinking to yourself, that's a good thing. I don't have answers when it comes to the reasons behind this, but I'm hoping my next guest does. I am joined by Clinton Wilkins from Centum Home Lenders Limited. Good morning, Clinton.
Thanks for having me, Derick. How are you?
I'm doing great, Clinton. And I think there is a lot of confusion around this sort of thing, Clinton, when we look at just how much inflation has gone up and people are struggling in so many different ways when it comes to, paying for their fuel and utilities and food, putting groceries on the table. And then we raise the interest rate to borrow money. Can you explain why the Bank of Canada makes a decision like this, Clinton?
Part of the reason that they made this decision is the inflation numbers are not where they need to be or where they wanted them to be kind of at this stage. We actually heard reports, and it was on the news on many media outlets, that the inflation rates have actually increased over the last period. And that's part of the reason that the Bank of Canada is increasing this key rate. Economists were really on the fence, I think, leading up to this announcement. There was one school of thought to say, they've done all the increases that they can do. They need to wait and see and kind of see what's going to happen, 1, 2, 3 months down the road. And then there were another set of economists saying that there is a little bit more room for the Bank of Canada to increase. And, those other 50% of economists were, predicting that there was going to be a 25 basis point increase in this key overnight rate to just try to stay that inflation even more. Obviously, a couple of the big inflation drivers, you hit on it already. One is housing costs, and I think the other is food costs. Those things are really impacting Canadians every day, and we're certainly feeling the impacts when we go to the till, when we go to the grocery store and we're trying to buy our groceries. That cost is higher. And now today, any consumers that are in a variable rate mortgage product or have a home equity line of credit or really have any debt product that's tied to this key overnight rate, their cost of borrowing is going up.
Okay, but at the same time, I think a lot of listeners say to themselves, we understand, I guess, the formula to a certain extent, but at the same time, is this not going to make it harder to pay my mortgage? If I have my mortgage renewal coming up, or I don't have a fixed rate and I'm at a variable rate, this is going to hurt me while I'm also struggling with all of those other things we just talked about.
100% it is. And, us as Canadians, we sat at home for 2 years and didn't spend any of our money, Derick. What's happening now is, obviously, as things reopen, and, I think things are wide open right now, we had a lot of funds available to go and spend, and that's really impacted things like supply chain, and that started driving up the cost of a lot of these consumer goods. So by increasing these rates, it is increasing the cost of borrowing and taking, a big chunk of money out of consumers' pockets every day, which they're trying to get consumers to reduce their spending. And, it's very tough because, for 2 years we were told to stay home and not do anything, and we didn't spend. And now really the government is telling us to say, we can go out, we can live our normal lives, but now don't spend on consumer goods. So it is a very, tough situation. And, I think our real concern is, the government is trying to cause a recession here.
Right.
And by a recession, there's going to be major job losses. And, I think that we need to kind of balance out the increase in the inflation and slow the spend on consumer goods with that recession that's going to come down the road. So I think both are going to have negative, economic implications. Right now, the increases that we've seen in the rates the last 12 months, Derick, have not been enough. And that's really what the Bank of Canada is saying today by increasing it.
It seems out of touch in some ways too, Clinton, because as you just described, like during the pandemic, we had lockdowns and people aren't spending money. And then at the same time, during those lockdowns, we have all of these small businesses that have struggled. They're not up to even what they were doing, financially pre-pandemic. And then we tell, then all of a sudden we tell consumers, hold on, we need you to slow down buying things so that we can help bring the inflation rates down. I wonder.
There's going to be losses for sure.
Yeah, but why are they so out of touch with those kind of things, Clinton?
I think maybe things were too low for too long, Derek. They should have started the increases earlier. It was basically a runaway train when it left the station, and that's what they're trying to get under control. And this may be several months, if not years, to kind of get inflation under control, and I think that's a concern for Canadians. It's not just the Canadians that are in a variable rate mortgage, though. We've lots of Canadians that are in a fixed rate that are coming up for renewal, and they're used to very, very low rates. Like we have customers that are sub 2%. What happens when those consumers come up for renewal? And I think in some cases, those consumers are in even worse shape because they're living in this false reality that the rates are going to be low for a long time. And the Bank of Canada has gotten this right 0% of the time. So I think you hit on it a little bit. They didn't get it right when they said during the pandemic, rates are going to be low for the foreseeable future. Well, that wasn't true. And now we're obviously in an increasing rate environment when consumers really thought maybe we were going to be more in a plateau situation. I think the goal now needs to be that the rates will plateau, because historically after a plateau situation, the rates will go down again, especially if we start going into a recession. So, there's no right answer.
Okay.
And I think that's what's really tough. And this is impacting different people in different ways. But I can tell you that Equifax and TransUnion have already put out, information that they're starting to see cracks in the Canadian, credit profile. Canadians are starting to miss their loan payments. Maybe not so much their mortgage payments, but there are other credit facilities that they're starting to miss their payments on. So the pain is already starting. We're certainly talking to consumers every day, and they are feeling the pinch. I can tell you we're talking to consumers that are coming up for renewal or maybe in the middle of their term, and they're looking at taking longer amortizations on their mortgage to reduce the borrowing costs to help not just with the mortgage, but with everything else that obviously has gone up in cost as well.
Clinton, I think you touched on something else that we've discussed. In particular, I remember Rob Snow talking about this as well with an economist or financial expert, and that is, maybe we've brought them historically too low. And maybe there should be a point, like the government looks at inflation and, for the last 25 years, they've decided that, 2% is, sort of the goal of what we want to stay at when it comes to inflation. I wonder, does the bank, is it time for the Bank of Canada to kind of do the same thing where, we shouldn't get to a point where it's 1.25% or 1%? Maybe it needs to stay at 3% to make this realistic, so that if something like this happens within our economy, people aren't as desperate as they are right now.
I agree. I think the pendulum swings too far both ways. So I think it has swung too high now, and I think maybe during the pandemic it had swung too low. But there was so much uncertainty, and people were really worried about their jobs. And during the pandemic, a lot of people did lose their jobs. But not only did the Bank of Canada reduce the cost of borrowing, the banks also stepped up to the plate, obviously with help from the government around things like deferrals and things like that. So there was it was multi-pronged, but that's what we're paying for now. There was really too much money pumped into the economy during kind of those harder times. We should have had losses earlier on, but the losses are coming, which is unfortunate, and we're going to, I think, have, a harder economic time kind of in the back half of this year. And I think going into 2024, I think we're going to see, really what impacts these higher rates are going to have on the economy. I don't think it's going to be rainbows and unicorns here for the next several months and into the following years until this really kind of balances out. But I agree with you. Maybe 2% for inflation isn't realistic. Maybe it needs to be 3%. And maybe the rates don't need to go as low or as high. I think there is a median mark. And typically what they've said before, the median mark for rates is somewhere around 5%. But we're far beyond that now at this point.
What advice are you giving to clients right now, Clinton?
A lot of consumers are choosing to do a shorter-term fix, Derek. Is that the right answer? Not for everyone. If you're in a variable rate, you probably took a variable rate for a reason, and really the rates have been high for a year. We don't know when they're going to go down, so I think you really need to think about that and think about the dollars and cents that are in your household. Obviously, the pros on a variable, if you break your mortgage early, it's only 3 months interest, and you can also convert your variable rate into a fixed rate at any time with no penalty. I think on the flip side of the coin, the fixed rates currently are lower than variable, which never ever happens, but we're not in a regular time. You need to think about, is a fixed rate for you? Because obviously if you break your fixed rate mortgage early, you're going to pay a much higher penalty, and sometimes a fixed rate is a long-term solution to a short-term problem. So I think seek the advice of an unbiased mortgage professional in your area. There's a lot of moving parts, and I can tell you, I'm glad of being part of the conversation. I've been doing this for 17 years, and I've done over 5,000 transactions and like $1.4 billion worth of mortgages. So I think I've always seen something, but this is always changing. So I'm glad to be part of the conversation.
And we're glad to have you as part of this conversation today, Clinton. This has been a great conversation. Thank you so much for joining us.
Thanks, Derek, for having me.
No, really appreciate it. Again, that's Clinton Wilkins, Centum Home Lenders Limited. If you're looking for someone to help you out through these difficult times, give Clinton a call. I really think he broke it down so well for us, and this is a conversation I think, members of the public, I think we need to be having a little bit more to get a better understanding and to hold the Bank of Canada up to a greater standard and our governments up to a greater standard when it comes to things like this. Thank you so much. Really appreciate, again, Clinton, you spending some time with us. We're going to take a break. We'll be back with more. This is Derick Fage filling in on the Sam LaPrade Show. You're watching on Rogers TV and listening on City News.
Sam LaPrade will be right back on City News.
101.1 FM and 1310 AM.